Hi all, good evening and welcome. I am Ujjivan from the Corporate Communication team, and on behalf of CareEdge, I welcome you to our today's discussion on small finance banks. Credit cost impact wanes, but capital challenges emerge. We sincerely appreciate your time in joining us for this webinar. We welcome our esteemed guest panel speakers for today. Mr. Ittira Davis, MD and CEO, Ujjivan Small Finance Bank. Mr. Govind Singh, MD and CEO, Utkarsh Small Finance Bank. This session will be moderated by Mr. Sanjay Agarwal, Senior Director at CareEdge. We will commence this session with a presentation by P. Sudhakar, who is the Director at CareEdge. This will be followed by a panel discussion. We will be having a Q&A session with the audience at the end of the discussion. And in case of queries, you are requested to key in your panel. Now, may I invite Mr. Sudhakar to make his presentation?
Good evening. Thank you, Mehak. We'll now take you through the presentation on small finance banks. Credit cost impact wanes, but capital challenges emerge. Major takeaways from this presentation would be, it's more than 6 years since the first small finance bank started operating. During this period, with strong focus on liabilities franchise, Sfbs have improved their credit deposit ratio sharply. Sfbs have achieved significant diversification in the loan book, along with strong growth in advances. Asset quality of Sfbs have seen sharp deterioration during COVID-19, majorly on account of unsecured nature of loan book. Profitability of Sfbs largely influenced by the loan book mix. While credit cost impact wanes, challenges emerge on capitalization front. The Union Budget for FY 2015 cited the need for differentiated small finance bank to further the financial inclusion in India, following which RBI published the draft guidelines for licensing of small finance bank on June 17, 2014. The objective of promoting Sfbs is furthering financial inclusion by providing saving vehicles to unserved and underserved sections of the population and furthering supply of credit. On receipt of final license from RBI, the first Sfbs became operational in April 2016. And as on date, there are 12 Sfbs operational. At the end of FY 22, total business of Sfbs stood at 2.79 lakh crore rupees, with deposits of rupees 1.44 lakh crore and advances of rupees 1.35 lakh crore. As Sfbs are predominantly to further financial inclusion, they are required to lend minimum 75% of their adjusted net bank credit to the priority sector, as against minimum of 40% requirement for universal banks. Also, Sfbs must ensure that at least 50% of the loan portfolio has ticket size of less than rupees 25 lakhs to ensure granularity of the advances book. The minimum capital adequacy ratio to be maintained at all times is 15%, with minimum tier 1 CAR of 7.5%. Now we will move on to key industry trends. Let us look at how liabilities profile moved over the years. As most of the Sfbs transitioned from being Nbfcs MFIs, major challenges faced by them in the initial years was mobilization of deposits. Sfbs have done commendable job on this front and built a good deposit base by setting up liabilities-focused branches. The proportion of deposits in total liabilities has steadily increased, and correspondingly, the proportion of borrowings has declined over the years. The chart on the left shows that the share of deposits in total liabilities has increased from 38% as on March 31, 2018 to 72% as on March 31, 2022. With growth in deposits, the credit deposit ratio has sharply improved to around 93% as on March 31, 2022 from 177% as on March 31, 2018. Further, with the replacement of borrowings with deposits, average cost of funds declined from 8% for FY18 to 5.9% for FY22. The chart on the right shows year-on-year growth in deposits. Deposits of Sfbs grew at a 4-year CAGR of 40% as against 4-year CAGR of 16% for private sector banks. which although on a smaller base has helped SFBs to gain market share. Now let us look at the advances profile of SFBs. The advances book has grown at a 4-year CAGR of around 30% as compared to private sector banks, which grow at a 4-year CAGR of 18%. Majority of the SFBs transition from being microfinance institutions, resulting in microloans being the largest proportion of loan book for the SFB industry. There has been gradual shift in loan book proportion towards non-MFI with focus on secured products like loan against property, vehicle loans, home loans, and loan against gold, resulting in the share of MFI declining from 41% of advances as on March 31, 2018 to 33% as on March 31, 2022. During the same period, share of secured loans in total advances increased from 44% to 56%. Though at the industry level, share of MFI has come down to 33%, in respect of many of SFBs, MFI still accounts for more than half of the loan book. As in the case of deposits, SFBs also have reported relatively higher growth in advances during the past 4 years. SFB share in advances of banking industry has gone up from 0.4% as on March 31, 2018 to 1.14% as on March 31, 2022. Though the share continues to be smaller, the same has been achieved in highly competitive industry scenario amidst highly volatile external environment. On the financial inclusion side, it's worthwhile to note that share of Eastern, Northeastern, and Central regions in advances and deposits of SFBs increased significantly in the last 4 years ended March 31, 2022. At the same time, share of Southern and Northern region witnessed a decline. Since the inception of SFBs, the market has seen several disrupting events like demonetization, GST, and recently the COVID-19 pandemic. Let us now look at how SFBs have fared and what has been the impact of COVID on the asset quality and financial performance of SFBs. The asset quality of all lenders was impacted in the last 2 years due to COVID-19 induced economic slowdown. Among the various lenders, besides MFIs, SFBs were more severely impacted due to exposure to relatively weaker borrower segment. Especially SFBs with larger exposure to unsecured loan book had a higher impact. It can be observed from the chart on the left that SFBs saw a sharp jump in their NPAs in FY21. With the severity of COVID-19 subsiding and resumption of economic activity, the NPA levels have declined during FY22, but remained higher than pre-COVID levels. In addition to NPAs, there is a stress in the form of restructured assets. As it can be observed from the chart on the right, standard restructured book has nearly doubled during FY22 and remained higher at 3.56% of gross advances, which was higher than the overall banking sector restructured book of around 2%. Gross stressed assets, which include gross NPA and the standard restructured assets, stood at 8.4% as on March 31, 2022. Now let us look at how has been the relative asset quality performance of SFBs. If one compares the impact on the asset quality with private sector universal banks, there was a sharp increase in NPAs for SFBs during COVID. At the same time, NPAs of private sector banks did see an improvement as many of the large corporate accounts got resolved, which has more than offset the slippages in retail and MSME segment. Further, various relief measures and regulatory packages announced by the government and the regulators have reduced the extent of slippages in universal banks. Now we will look at the impact of COVID on credit cost and profitability. As slippages increased during the times of COVID, there was an increase in credit costs through higher provisioning and write-off. This severely impacted the overall profitability of SFBs, and within this, impact was higher for MFI-focused SFBs. For the purpose of analysis, SFBs having an MFI exposure of more than 25% in its loan book is classified as a MFI-focused SFB and rest as other SFBs. As per the same, there are 3 SFBs are classified as other SFBs and rest are classified as MFI-focused SFBs. A trend that we see in MFI-focused SFBs is that they are more prone to event risk, and I have seen 2 major events during the last 5 years, namely demonetization and COVID. In this chart on top, we have depicted the impact of credit cost on return on total assets for MFI focused SFBs, and in the chart on the bottom, the impact of other SFBs. Red lines on the chart show the trend in credit cost, and dotted lines show the trend in profitability, that is, return on total assets. The charts clearly indicate that MFI focused SFBs were more severely impacted as their credit cost shot up during COVID and remained higher both in FY21 and FY22, leading to sharper decline in ROTA as compared to other SFBs. While the asset quality challenges continue to wane, SFBs now face challenges in mobilization fresh capital. The chart shows the capitalization level of SFBs. Post demand, the capital cushion improved due to fresh equity mobilization by few of the SFBs. However, this was depleted due to combination of high advances growth and rise in credit costs during the COVID-19 pandemic. Also, the incremental capital raise is showing declining trend while the advances continue to grow at a higher rate. There were 5 SFBs in the market to raise funds via the IPO route for a sum of rupees 5,600 crore on aggregate basis. Of this, around rupee 3,000 crore consists of fresh equity issues. Many of the SFBs filed the DRHP more than 6 months to a year back, however, unable to raise equity within the expected timeline. Further, the current volatility in capital markets, along with reduction in level of risk appetite in equity markets, poses uncertainty on equity rise. The regulations allows SFBs to raise Tier 2 capital to the extent of 100% of Tier 1 capital. However, at present, the proportion of Tier 2 capital is significantly lower for the industry. As it can be seen from the chart, while Tier 1 cost stood at 18.7% for the industry, as on March 31, 2022, Tier 2 cost stood at 1.9% only, leaving ample scope for the industry to raise funds. Further, it can be observed from the chart that the quantum of Tier 2 capital raised also has been coming down in the past 3 years. Capital raise remains key challenge with deferment of IPOs, which may stall growth of few SFBs in the near term. Also, the momentum in raising Tier 2 capital is slow, probably due to demand or cost metrics. Now, let us look at the near-term outlook for the SFB industry. Advances growth for the industry is expected to be around 24% in the current financial year, as per CARE estimates. However, in respect of many of the SFBs, present level of capital would be adequate to grow the book in the range of 15 to 20% only. Hence, the major chunk of this growth will be garnered by SFBs with comfortable capitalization level or SFBs which can generate healthy profits. In respect of credit costs, CARE expects the credit cost to show meaningful reduction in FY23 with reduction in NPA levels and creation of adequate provision in the past 2 fiscals. Will capital constraints impact the growth for the industry? Let us listen to our industry experts. Now I request Mehak to take forward.
Well, thank you, Sudhakar. Now may I invite Mr. Sanjay Agarwal to take over the session.
Thanks, Mehak. Good afternoon, everybody. Thanks a lot for joining us for this webinar. We have 2 guest speakers for the day, both of whom have a very strong background in banking. Mr. Ittira Davis, a senior banker with over 40 years of rich experience. Next slide, please. Has worked extensively across various countries. He's been with Ujjivan since March 2015 and oversaw a successful evolution of MFI into an SFB. And this includes accessing the capital market with 2 successful IPOs. Mr. Davis was appointed as the MD and CEO of Ujjivan SFB in January 2022. Mr. Govind Singh is the founder and currently the MD and CEO of Utkarsh. He is a career banker having worked in various PSU and private banks and at various levels. He thus brings in the breadth of experience and expertise across banking verticals. We now move to the main session of the day of hearing views of our esteemed guest speakers. To begin with, we would like to point out to speakers and the audience that this discussion is on overall industry prospects of SFBs and not on any of the individual companies any of the speakers may represent professionally. Hence, none of the views can be constituted to be any assessment of any individual company. So we start with Mr. Singh. The CASA ratio for SFBs has seen an improvement over the period. However, the cost of CASA continues to be high due to a higher rate of interest offered by SFBs. What should we expect of the SFBs to improve CASA ratio further, both in terms of quantum and of cost? You are on mute, Mr. Singh.
Yeah, thanks, Sanjay. Thanks a lot for inviting us. So, as far as CASA is concerned, I think there is a good momentum we have seen during last 5 years across all SFBs, and our sense is that this will continue for at least next 3 to 5 years time. When I say 3 to 5 years time, I think till the time all SFBs reach in the range of 35-37% type of CASA. There are some people who are beyond that also today also, but I'm talking in general, people should be in the range of 35-37 in next three years or so. You'll see around 4-5% increase in CASA on a year-on-year basis from here. That is our estimate or the way things are happening. The point that, what is the type of cost reduction will happen in case of CASA. So we understand that banking is, is a long business. Banks are there for centuries. They take at least a decade to be a established player in their own space. So it does take that time. We have seen in the established universal banks also who are there today. They have taken around 7-8 years time to reach around 30s or early 30s in terms of overall CASA percentage. The cost, obviously, because we are new players, so the trust factor, the overall book size over the number of customers are lower for SFBs today. Obviously, it is increasing with passage of time, but it will take some time to actual having a reduction in the cost of CASA as far as SFBs are concerned. We have seen in other private sector banks also, during last 4 or 5 years, their cost of acquisition CASA used to be higher. Their rate of interest on a CASA used to be higher, and gradually it is coming down. Same will happen with the SFBs also. My sense is next 3 to 5 years time, we should see at least 200 basis point decline in the cost of CASA as far as SFBs are concerned. This is my estimate only. And they will not be obviously reach what the established PSU or private sector banks are there, but a shade above that. They may not reach that level, but certainly not at today's rate. It will be much lower than what it is today. And it may take another 2 to 3 years time. That is our sense. Because now all the SFBs are getting general book. Their balances are building across. The stability of the CASA book is also increasing gradually. And I think one important thing what you also showed in your slides that when all SFBs started, they're highly dependent on the term loans which they had taken from the all banks. The first job was to retire those term loans and get a deposit base. I think all of us have done successfully that part. Close to it is almost 100% below now our CD ratio. So once you have a comfortable CD ratio, your pressure on paying higher rate comes down. I'm not saying it goes away, it comes down. So my sense is next 2 to 3 years time will be important from that angle. There will be significant reduction in the cost of CASA, what is there today for SFBs in this period.
Okay, I think 200 is a very significant reduction for the 3-year period, especially when the growth you are saying is still very high and the CASA ratio still has to come up to the terms. So, Mr. Davis, till date, SFBs have done a good job in terms of establishing what I would call greenfield liability franchise amidst high competition in the banking industry. Credit to deposit ratio, as Mr. Singh said, it's in a huge improvement right now. So now, but it's still high at a 93%. So do you think it is possible and viable for the industry to further improve this, or do you think this is a very relatively safe sort of level?
Good afternoon, and thank you for the invitation. Pleased to be here. No, I think that's a very good question you have, because the deposit ratio, the CD ratio, is basically a function also about the growth in the asset book. Now, you have shown in your slides that the SFBs are growing, other than perhaps during the COVID times, much faster than the other banks. So asset base growing fast with liabilities base not able to keep up, that becomes a question, that becomes an issue about the CD ratio. But having said that, I think, when you look at where the SFB started, most of them were MFIs or Nbfcs who converted to banks. They all started with an asset book. And as Mr. Singh said, all of them had to give away the wholesale liabilities, which was supporting the asset book, and go for retail liabilities. So 5 years is a good time to build a base. So going forward from here, going from 93 to a more acceptable 80-85% shouldn't be a problem. But the growth of deposits will have to keep pace or be faster than the growth of assets. Only then you can get down to 80-85%. And that, I think, is a target. And that, I think, is the way in which even the Reserve Bank of India would like to see all of us. So I think all the banks in this industry are trying to get a good CD ratio going forward.
Okay. Good. I think, CD ratio, obviously, as you said, the deposits have to grow as fast or faster than the assets. So 85% is a decent level. Many of the large private sector banks are aiming at those levels, give and take a quarter here and there. Now coming to the slide which Sudhakar had presented. So when we are discussing the MFI, since many of the SFBs have originated from MFI, so due to the exposure to rural and relatively weaker borrower segments, SFBs are seen to be prone to event risk, and the same is visible in the form of increased stress asset during COVID-19. So having gone through this COVID-19, how are SFBs placed to manage the event risk going forward?
Who would you like to?
Yeah, Mr. Davis, could you please?
Yeah, no, I think, see, the thing is that during COVID, it was not really the rural segment which was affected. To some extent, rural segment was able to withstand because they were less affected than the urban and semi-urban areas. So I think if you look at and we have done this segmentation, and we see that the segment which was really affected was the informal segment in the urban and semi-urban areas. So these are the people who could not, for whatever reason, lost their jobs or had to give up and had to move out. So these are the people who were more affected. So the rural areas, in my view, in this particular case, were able to withstand the effect of COVID and did fairly well. And also, I think, from our experience, since we are all across the country, we found that perhaps the North was able to withstand the COVID effect, at least, later part of it, better than other parts of the country in terms of the economic effect. Although there were more cases of COVID, etc., but if you look at the economic effect, we find that regionally, the North was better off than the other three regions. So this is our feedback. So I don't really think the rural was a factor to be worried about.
So I think the larger question is that how are SFBs now placed to manage event risk? Because event risk will continue to happen in the economy. So how do you see the SFBs placed to manage the event risk going forward? Mr. Davis?
Yeah, the event risk is something, the SFBs and those who are got predominantly larger book in MFI have to accept the fact that we are able to get higher returns, and therefore corresponding to that is higher risk. So the only way to manage that is higher capitalization. So capital ratios will have to be in corresponding to the business. So if you are a bank with only 50% in microfinance business, then a risk model is different to somebody who's with 70 or 75% MFI business. And that is something that these two black swan events, demonetization as well as the COVID, has shown us. And it is something that we have to build into our business model. So the CRAR or the capitalization ratios of the SFBs will have to be linked to their business models. And I think that is the only way forward in terms of managing this risk.
Yeah, right. I think because at the end of the day, even after two significant, or let's say two parts of the COVID, so three significant event risks, the SFBs have been able to stand the ground, and the CD ratio is at 93% and all that. So correct. So I think that's a very correct way of depicting things. Mr. Singh, at the industry level, the share of MFI in the total loan book was about 33% as on March end this year. However, for most SFB, the proportion of MFI book continues to be high. So how do you see continues to be high? So how do you see this panning out in the long term?
Yeah, here again, I see, after becoming a bank, all banks started the process of, you can say, decentralizing not decentralizing, trying to get, diversified book in terms of product and in terms of geographies. And that is the process each one is doing. The only challenge is, those who are, say, MFI, they were doing MFI business for decades. And starting a new business, be it a housing loan, be it MSME, be it gold loan, be it wheels, whatever you do, it takes its own time. There are a lot of learnings happen. So because of you have a large base of microfinance, even the growth is larger. Absolute growth is larger in case of microfinance. That is, you can say, mathematics of why this is not coming down sharply. But the way I think all have made the efforts. You go to any bank nowadays, I'm talking new Sfbs, they have clearly the verticals which are focusing on these books. So my sense is, again, we should see around 25-30% decline at least in next 3 years time or so in the MFI book of SFB in general. That should happen, and that will be you can say captured by MSME, housing loan, wheels, small corporates, and gold loan type of new asset classes. What happens with any NBFC segment or company is that they are specialized in one area of activity, one line of activity. And if you're into wheels, you are normally good in wheels. It takes a lot of time to move from wheels to other things. If you're gold, we have seen gold companies, they are there for 20 years, 30 years, 40 years. They're trying to get into other asset classes. But today also they are struggling. They may be 98% gold and 2% other asset classes. That way, SFBs have done a much better job. Yeah, expectation could be that it will happen faster, but I think if you do faster, then there may be a lot of challenges, because you are getting into some area which is unknown so far for you. The DNA of the institution is a little different, how to operate as an MFI. So it has taken a little longer time. But if you see the last two odd years, the growth of non-MFI book is much faster. And MFI book in normal say may grow by 15-20%, whereas the other books should grow by almost doubling every year because the base is small. So my sense is 25-30% decline overall basis in non-MFI book, MFI book, and that share will go to the non-MFI book in next 2 to 3 years. Around 3 years time looks quite reasonable to me and should happen.
So you are indicating share, right? You're not indicating, let's say, the absolute amount of MFI exposure would come down. You're saying the share of MFI exposure would come down relative to the overall balance sheet.
Correct. I don't foresee that MFI absolute number will come down, because this is one business. Most of the people, whatever is your core business, if you are doing MFI and microfinance business for last 20 years, 15 years, that is one thing you understand well. The challenges of demon or of COVID are different, but otherwise normal course you understand that well. From impact angle also, it's a financial inclusion, and your heart lies there. What you are doing for the rural folks or for the underpenetrated area, underserved area. So I don't think anyone would like to come out of it. The ratio of the growth or the rate of growth will certainly be lower for microfinance, because that is a larger book, and growth rate for others will be higher. But absolute number, MFI book will certainly grow from here also.
Okay, great. So Mr. Govind Singh, regarding this capital, which I think is the most critical thing the analysts have been looking at nowadays, especially for the SFB. The analysis which we put forward indicates that in the past few years, the quantum of equity capital mobilized has been witnessing a declining trend. And then many MFIs have filed DRHP but could not raise capital, even though the equity market decline happened much later. So what are the challenges SFBs are facing in terms of attracting capital, and how do you see the way ahead?
So I think one good thing with SFBs was that they all were having very high capital adequacy. If you see historically, there are SFBs even at 30% plus also, even today also, but those may be exception. But in general, people are in early 20s or mid 20s as far as the capital adequacy is concerned. People have raised money during last 2 years also through tier 2 and tier 1. Unfortunately, tier 2 market has a lot of challenges we are seeing. It's not for SFB specific. The overall tier 2 market has gone down for multiple reasons, which are not related to SFBs, but are more related to the way tier 2 are looked up by the industry as a whole. In terms of tier 1, my sense is, yes, there was a challenging time when it was not specific to SFBs actually. It was specific to type of lending we are doing. So I think unsecured lending was, is not flavor or favor as far as the capital market is concerned for some time. Especially last 1 year has been challenged from that angle. Though all have raised some part of equity during this period, and market was not found that conducive for the public offering. People have started the process, they got good response, but suddenly, I think not only COVID, but other global environment also became little difficult during last 6, 7, 8 months time. And what we hear from market also, we are also in touch with constant touch with various bankers and other people in the market. The sense is that the worst is over. You are seeing a good commentary, good trajectory as far as all banks, including Sfbs, are concerned. We are seeing a positive trend in March. June, that trend continues. I mean, we are seeing good profitability coming back. If this trend continues for another quarter or so, I think the market will again completely revive. I mean, market come back to the same level where it was, you can say, 2.5 years back. So yes, there was a you can say dull or lull period as far as capital market is concerned, especially the public market is concerned. But the way things have happened and the way things are happening, you will see the type of trends we are seeing in terms of collection, in terms of disbursement, in terms of expansion, in terms of overall profitability, and the way deposit franchise has remained intact in spite of COVID. The growth of around 30-35% on advances. I think all those are indicative that Sfbs is a very robust model. It was a temporary challenge during this period, and that is almost over or about to be over. So we'll see again, investors coming back and supporting Sfbs.
Okay. In the meantime, the audience can key in their questions, and we'll take it in this session along with the other questions. So, Mr. Davis, what do you think is the growth expectation, and do you think the present level of capitalization is likely to impact the industry advances growth going forward?
I think the growth, now that COVID is behind us, or we are managing the COVID conditions, I think we will slowly see the Sfbs getting back to their normal level of growth, which on an average would be in the 30s or the mid-30s level. That should come back either this financial year or at least by next financial year. So I think that is a good level. Obviously, that needs to be supported by capital, and also tier 2 capital is also a factor. And Mr. Singh alluded that things are getting better. And I think that should help the business going forward. In the meantime, I think the Sfbs still have some room, in the existing capitalization ratios. So they will be able to continue and build on that. So I don't think, there will be any setbacks to growth. It'll be the question of whether you grow in the mid to the high 20s or to the early 30s sort of level, depending on each one's circumstances. Each of the Sfbs have their own particular circumstances, but growth will be above average in terms of the banking industry. That much, I think, as a group, I think we all feel that is possible.
So you're saying that the Sfbs will continue to gain market share from whatever level they are today?
No, absolutely. Especially on the deposit side and on certain areas like affordable housing, MSC and things like that. I think that will continue to see some growth. And also, let's put it this way, the number of Sfbs are increasing. I think it's a model that the regulator has found to be acceptable. And we may see more licenses coming, and in a 12 to 18 months, we may be 20 of us. So I think, the numbers are growing. That will automatically also increase the share, and the model will become more acceptable to the business community and to the individual investors.
Okay, that's a very interesting point. So you are indicating that the regulators have tested the model, and they feel that it's a model which is viable and which is successful. So they're encouraging other parts of the banking sector to move on to this model. So because at the beginning of the discussion, you had indicated that even payment banks and cooperative banks are being asked to move to an Sfb model. So yes, this is a model which the regulators are now very comfortable with.
Sure.
Okay. So coming to the role of Sfbs,
I think Mr. Singh would like to say something.
Okay, sorry, yeah.
So another factor beyond what Davis just mentioned. So profitability of especially Sfbs were muted last 2 years. So in normal course, they will show much better profit because a lot of provisioning had to happen. Let us accept the fact of life. So this year, I think the profitability part also will be much better for all the Sfbs. That will also add to, you can say, the capital adequacy of all these Sfbs. And that itself will give a significant room. It may not give 30% type of room, but it will give a significant room as far as the growth is concerned. Even internal accruals will be significantly higher this year, which were not there for last 2 years. And one more factor which I want to place here is that so whenever we talk of 4-year CAGR type of things, so what normally happens in first 2 years, you have to establish the model. You have to tell that, okay, you are a bank. Initially first 6 months, 1 year, people will say, okay, are you a bank? Are you recognized by RBI? Are you a registered bank? Are you not a chit fund company? Are you not a cooperative bank? I think all those questions are there. So first 2 years a struggle because of that. Now I think because these are well established, there are four established listed players also, and 4-5 are in pipeline. I think the acceptability and the marketability will become much higher. So my sense is the growth will be much smoother going forward, and even capital will be available. No, it should not be a problem. So we don't foresee any much challenge. Individual institution may have their own growth rate or thought process, but industry as a whole, SFB industry as a whole will grow steady from here. But that is what I want to say.
Right, and the fact that which you mentioned earlier, that some of the deposits were replacing the existing liabilities, so that replacement will not be required. So
yeah,
whatever
true.
comes to the actually adding to the balance sheet size. Right. So, Mr. Davis, SFBs have been conceptualized with the objective of furthering financial inclusion. Currently, SFBs have a 1% share in credit, but a 7% share in the number of accounts and about 4% share in the number of branches. So, in your assessment, how has been the industry performance with respect to the achievement of the same?
No, I think the objective has by and large been met, because in terms of, first, of course, there was the requirement that 25% of our branches had to be in rural, unbanked rural areas. So that was an important factor that was achieved. Then, 75% of the portfolio has to be PSL, and 50% of the loans have to be below 5 lakhs. So all of this are pointing to financial inclusion. And also, I think many of the SFBs have been promoting financial literacy in the communities that they are doing work. So, while the share in the banking business may be 1%, if you look at, as you rightly said, the number of customers and deposits and other numbers point to the fact that we are punching above our weight. So I think that is a factor which is being taken note of, and I think also the bigger banks are considering those points when they develop their strategies, which is why some of them now feel that they should be coming into our marketplace, which is interesting. And I think we are also trying to get into their areas like the MSC and housing markets. So I think it's a very healthy competition. So it's something that is going to stay. And at the end of the day, if the consumer and the depositor is benefiting, that's the best thing. And also, finally, the shareholder also needs to benefit.
Right. Yeah, so Mr. Govind Singh, your views, how successful has SFB in meeting the various stakeholder objectives, like let's say the regulator, the depositor, the liability, the borrower, the shareholders? How successful has the SFB been in meeting these objectives?
So, as far as regulation is concerned, I think we have been interacting with the regulator on a regular basis, and the compliances for SFBs are as at par with any universal bank. And in terms of, especially on two counts, one is the compliance part, and second on the technology part. I think either they are at par or sometimes they are superior also. So I think that's a good benchmark. The governance part has been very strong for SFBs. The customer's focus has been because I think that is the type of DNA SFBs have. So customer focus is certainly much superior than even the mainstream banks. So I think overall model from the regulatory angle and from the general angle has been very, very good. Your own data that, for 1% share, we are having 7% number of clients, SFBs, that shows the type of granular we are going. We are going to hinterland, we are going to semi-urban and rural area where normally people are not willing to go, and we are using technology in a big way. So I think that is already helping the customers and all the stakeholders for sure. And this journey will continue. This process will continue. I think we are going to, besides obviously we are in large cities also, but we are going to in hinterland and interior area with newer products and with more of technology use. I think the way it was emphasized by RBI, that is happening in a big way, and that will continue to happen. Our focus will remain on the financial inclusion, remains our main agenda, besides the other aspects of banking. So I think overall, my sense is this has been a good experiment from the regulator as well as from the other stakeholders angle. The overall returns and other things, I mean, those are muted for some time, but certainly those will be at par or better than universal banks here again. And the franchise the way we have built, I mean, when you see the type of deposits and the type of advances we are doing, I think this franchise being built by SFB is very strong. Sometimes they may be very strong in some geography that can happen. But overall, we are seeing all their footprints. All are into 18, 20, 22 states. In fact, all the SFBs, and creating a good franchise on all counts. So overall, good experiment. And I think next 3 to 5 years will certainly be very, very crucial, because now we are going to next level in terms of overall growth, in terms of sometimes complexity of product, which is not there today, use of more and more technology. And as you mentioned, when we are growing, on a larger book, getting capital on a regular basis will be important. So I think 3 to 5 years are very important from that perspective. But last 5 years have been really satisfying. And the way it was expected by various stakeholders, including the regulator, the SFBs in general have, delivered that.
So yeah, coming to the same point, so how do you see SFBs balancing financial inclusion with profitability, considering that the costs, credit costs, etc. are higher? So how do you see the balance between the two?
So as I mentioned, people are, or all SFBs, their share of where you can say high yielding, assets like microfinance or other unsecured lending is slowly coming down. But at the same time, the cost of overall deposits, I mean, currently it is because of market conditions is different, but normally the cost of overall funds is coming down for them. At the same time, the cost of operations is also coming down. So there will be some stress on, not stress, there will be some decline or decrease in the NIM, maybe 100 to 150 basis point for SFB, especially those who have come from MFI background. But that is well compensated by the lower cost of funds in a medium term. At the same time, better cost of operations or lower cost of operations. So I think this will be managed. I don't foresee any challenge as far as SFB model is concerned from the overall economics is concerned, from the ROE or ROA or NIM is concerned. Should not be a problem, because we are getting benefits at both the sides.
Okay. So Care Copcom team, can you indicate how the audience can put in the questions, because they're having some issues? So can you indicate?
Yes, dear participants, you are requested to key in your queries in the panel below.
Okay, so there's a panel given to everybody. They have to key in the queries there, right?
Yes.
Okay. So again, Mr. Davis, when we've seen the NBFC is also having, when we touch the topic of technology and feet on street, we see NBFC is also having a significant, let's say, capabilities of adoption of technology and deploying feet on street. So how strong are the competition of NBFCs to SFBs?
The NBFCs, have been competing with the banks in the last 5 years. Of course, now those who are microfinance institutions, the RBI has come out with some new guidelines, which I think gives them more scope and ability to operate. So I think that is also an interesting development for the NBFCs. But of course, the biggest challenge NBFCs face is the deposit side. So the cost of deposits and managing that is something that is very important in the business model. So the small finance banks being able to take the customer deposits and manage that is a significant factor. And whenever there is any issues on the ground, managing deposits and having a deposit base can make all the difference. So I think while there is a challenge on the asset side, on the liability side, I think the small finance banks are in a better place.
Okay. So Mr. Singh, you spoke extensively of various products. So what are the other products which, let's say, are a good potential for SFBs going forward?
Yeah, so as most of the SFBs either were into microfinance or into the retail loans, like you can say MSME or affordable housing. Those are the rules. So my sense is going forward also, first they will focus more on retail. They are not going to do corporates. I mean, corporate could be there, but that will be single digit only. The large book will come from, besides microfinance, will come from things like MSME and affordable housing and vehicle loans, gold loans. So, these are some of the area I think all SFBs are working towards that. And there is a large market. These are truly retail market, which require, in spite of a lot of digital happening, still requires a good distribution network, which all SFBs are having. So I think these are some of these products which we think that will be the star products as far as SFBs are concerned in next 3 to 5 years horizon.
Okay. So a related question. So do you think there could be a scope for some sort of a wealth management, sort of a quality wealth management sort of a structure for your customer base? Because since you have now both assets and liabilities, so you think there could be any income flows from such structures?
Yeah, so SFBs have already started that part, but it is not significant right now. I think we all look at who are our wealthy customer, beyond a threshold limit in terms of deposits or in terms of things like life insurance cover or in terms of the loans they have taken from us. So I think all SFBs have already started that process, but it takes its own time. Because the wealth customer expects all aspects of banking are available. That may not be true today, but next you can say 3 years, 4 years down the line, you'll see all are having you can use the word premium, or you can use the word gold, or you can use the word wealth, whatever is the word. But the higher end customer, the high net worth individuals or high net worth corporates will be handled differently. We are seeing, because the moment you see our liability branches in terms of look and feel, in terms of even the manpower, those all are from universal banks only. So the DNA of DNA and the nature is on those lines only. Currently, because of the maybe higher cost of funds for us, we are not able to offer all type of products to these people. Suppose they require a housing loan, we may not be able to give housing loans at the rate which universal banks are giving today. So that may be a challenge which will come down in next 2 to 3 years time. But all have already started working towards you can say wealth customers, and not only things, but even 3-in-1 accounts or things like credit card. I think people are working towards that. A few banks have already launched also. So my sense is that 3 to 5 years, in their own way, they will have wealth customers also. Ultimately, SFB space will find at par with universal bank in terms of offering. They may not offer the very exotic or very risky products like options and futures type of things, but in general banking, whatever is expected by a normal customer should be and would be available through SFBs also.
Okay, so we are getting quite a few questions based on the MFI business model. So there is one question which says that JLG as a business model is undergoing change with the experience of COVID, leading to group dynamics getting diluted, or is individual lending taking precedence over JLG? So anybody would answer?
Yeah, so I'll agree to this. You can say assessment that yes, the group lending model will have some challenges, and we have seen in case of COVID also. But it is not that the model has gone completely. In fact, we have seen during COVID period also, the groups are willing to pay. There are some you can say some groups where we had challenges in reaching out those people, or those people coming to us. But two things are happening in a market. JLG model, the moment the ticket size becomes large, the group guarantee or the group dynamics can become weak. A 2 lakh rupee loan through JLG model is always difficult, preposition, getting someone. But for 20,000, 25,000, that's a very good model, in fact. So my sense is, and also a lot of technology being used in terms of, earlier we are not having any data about our customers, and that we are completely dependent upon the group dynamics. Now, because of technology, because of civil and a lot of other you can say health aids available, we are having much more data available of the customer. So my sense is, for a shorter loan, for those who are into MFI business and the other business also, for a smaller loans, people will depend more on the JLG to begin with. And once the customers reach a certain level, 25, 30, 50, 60,000 rupees, then they would like them to move to individual lending, because in individual lending, then you are having a proper credit discipline, proper credit process for evaluating those customers. So my sense is JLG model will remain there, but a certain segment of clients will move toward individual lending because of the various changes those are happening in the system. And at a large loan, it's difficult to manage group guarantees.
Okay. So, Mr. Devi, there's a question we have that we understand that many of the SFBs have exclusive branches focused on assets or on liabilities. So, is it not a higher cost model? Do you see these branches getting merged, or do you think this will be the way business will be done in the long run?
No, I think some SFBs have that model, but most of us have got common branches. So, it may vary in the early stages of the business, but in the later stages, I think they are bringing everything together. Ujjivan, speaking for myself, we have combined the assets and liabilities into one branch, because that model is definitely better and puts everything in one location. So, and that's useful in terms of customer cross-selling and everything else that comes with a customer service. So I think eventually most of the SFBs will start moving to a comprehensive branch model if they have not already done so.
Okay. So you're saying it's the stage of development of your organization rather than the business model itself.
Exactly. Because when we started, we all started as microfinance institutions, so we already had asset branches. So some of them you were able to combine it with the liability branch and make it one. Some may have to wait a little longer and do it at the right opportunity time. So I think that is just a question of time as a factor. But eventually, yes, cost makes it one branch in one location.
Okay, interesting question, Mr. Govind saying, are the present quality issues of SFBs on account of limited credit underwriting knowledge?
No, I don't think that is the issue. So as I mentioned, I think maybe I accept it also. Initially, it was taking longer time because, we were not having, you can say, trained staff for the other verticals. If it's microfinance, we knew it well. So that is the case with all the SFBs. They were into one or two niche area. For other area, they have to create from scratch. And so what happens, you compare with the established bank. Even the established bank took 3, 4, 5 years to create new verticals. Even banks who are there for 25, 30 years now, first 5 years, then they may not be in credit cards at all. They may not be into vehicles at all. They started vehicles after 6 or 7 years, in fact. So when you start something, first 1 year is, understanding, training people. You'll have some challenges also. You might make some mistakes also. That does happen in each business. So, but I think all have now mature, and we are seeing across, in fact, all SFBs are seeing they may have their own, they might have chosen their own area, whether they want to vehicle or MSME, affordable housing, gold, small corporate, whatever is there. But I think now they have matured. And one more important part is that I think there has been a lot of, lateral hiring by SFBs also. And there are a lot of people from SFB who are going to mainstream or universal banks also. So I think having low quality of credit will not be the case, which cannot be the case anymore. It's a matter of time only. It does take around 12 months to 18 months, sometimes 24 months time also to fully establish a new vertical. And especially when your DNA is that you are into microfinance or you are into only vehicle finance. So setting up other things sometimes takes time. But I think their quality of manpower, quality of underwriting, quality of all the processes, and the best part is their technology is superior than many of the established banks. So I think all these are anyway already in place. And now there are 5 years, so we don't foresee any challenge now.
Okay. So we got another question which is linked to the JLG model. So the question of JLG getting diluted for the last tickets loan. So do you think it will impact the credit cost or the JLG delinquencies or the MFI delinquencies?
Sorry, last sentence you can repeat.
So this dilution of the JLG model, do you think it will impact the JLG delinquencies or the MFI delinquencies?
No, it will not. In fact, as I mentioned, JLG model is intact. You go to semi-urban area, you go to rural area, and your ticket size is small. Now, because we must understand, if I'm giving a 2 lakh rupee loan, I'm not giving JLG. I'll go to MSME route. I will go to individual lending route, where my delinquency levels could be of MSME, not of JLG. So we should be mentally also prepared that JLG will work up to a certain amount. There, the delinquency level may be same, maybe a shade higher than what it was earlier, but not much different. Whereas for the other businesses, though currently we are not seeing many delinquencies in the individual lending book across, but ultimately this is unsecured lending of MSME in nature, lower end of MSME in nature. There, if JLG is talking of 0.5, 0.6, 0.7% type of delinquencies, it might be 1 to 1.25% in those cases. That is possible. But JLG will remain, barring the challenges of sometimes COVID happens or sometimes demon happens. Otherwise, there should not be a major impact because of JLG model only.
Okay. So now we have a question of other income. So in respect of affordable housing, we have seen many Nbfcs or HFCs establish strong market position. The ticket size is small, but this is a very sweet spot for the as far as ROTA is concerned. So do you think SFBs will be able to garner a significant asset base in this segment? So Mr. Davis, can you answer that?
Yeah, I think, looking at the locations where the SFBs are and the type of ticket size, it's the tier 2, tier 3 cities where the SFBs operate, and even in the rural areas where affordable housing makes sense, because in the bigger cities, these sort of ticket sizes which are given by SFBs will not go very far. So unless they are in the outskirts of the larger cities. So tier 2, tier 3 model is working. It's an area where there is growth. And with the branch structure and a brick and mortar structure which is available to the SFBs, they are on the ground, and it's a good model. It's growing successfully, and I think all the SFBs will be able to work on this model. Over a time, it will develop into a reasonably good size of book. So I think it's a business that we all need to take very carefully. From time to time, the competition is quite severe in terms of pricing, but we have to be very selective and choose what makes sense from a business perspective. And that is what we are finding when we are able to see that this is happening in the tier 2 and tier 3 cities where we are present.
So, Mr. Singh, coming back to the fundraising, so we see a lot of PE funding, PE funds which are focused on the financial services sector in India. So, do you see, let's say, any interest of PE funds in SFBs, or do you see any inquiries? How is it like?
Yeah, certainly, yes. So if you look at the one is in terms of governance and income compliances, we are at par with any other bank, established players. In technology, we are at par, sometimes even better than established players. If you look at the financial part, as I mentioned, last 2 years were muted because of the COVID scenario. But on a steady basis, if you look at SFB and SFBs are showing a better, you can say, returns or ROA, going forward also. So my sense is on a steady basis. I'm not talking of 1 or 2 years. On a steady basis, certainly this will be better than many of the established players. So there is no reason why PE players should not look at this class of assets. Second point is the growth potential. In terms of overall growth potential of SFB, because they have started and they are going into the area where not many people are there. They are going to places where so far the growth of trade has been less. So I think the opportunity is huge for SFBs. The rate of growth will be much better for SFBs. On overall count, I think in normal course, all P should be more than happy, and sometimes they may prefer also SFBs. This social and environmental agenda is also important for SFBs. I think people do talk of what type of impact SFBs are able to put, or what type of impact banks do. Banks do impact, but I think if you look at the impact part only, SFBs certainly have bigger and better impact than mainstream bank for sure.
Okay. So one question for both of you. So we start with Mr. Davis. So what do you estimate would be the growth of compounded annual growth for SFBs for the next 4 years in terms of advances?
Sorry, I didn't get, what is the...
So what do you think would be the compounded annual growth rate for the advances of the SFB sector as a whole for the next 4 years?
For the SFBs, I think 20-25% is compounded growth is doable. So that is something which is possible in the industry for the next few years. Assuming, of course, that all the other factors remain more or less where we are. Right now, the issue which is popping its head up is inflation, and how inflation is going to work out. So assuming that we manage the inflation situation, and the country seems to be managing that reasonably well compared to other parts of the world. So if that is under control, 25% is doable.
Okay, Mr. Singh, your views?
I may be a little higher than what Davis mentioned. My sense is 30% minimum. It may be 30 to 35%. For a simple reason, two important things. One is the base is small. Even today also, we are talking of 1 point something percent, is the share of SFBs. That is one part. And second, what happens in SFBs, we normally go with a smaller ticket. We don't go with 10 crore loan immediately, and we'll go maybe even 25,000 rupee or 1 lakh, or even in case of MSME, 2 lakh, 3 lakh, 4 lakh, 5 lakh. We have seen the growth for this segment of customer is much higher. A customer who has taken 10 crore rupee loan, he will not double in next 3 years time. But a person who has taken 2 lakh rupee loan, he can double, or she can double in next 2 years time. So the type of client we have got, I'm talking in terms of rate of growth. I mean, absolute number will obviously be higher for universal banks, but in terms of rate of growth for these two regions, base is low, and the type of customer we have got, the customer growth itself is very, very high, should help us. And also the expansion, the way our type of expansion SFBs are doing, in terms of employee base, in terms of the branch base, I think that will certainly give us 30 to 35% growth next, for next at least 3 to 4 years time for sure.
Okay, that's interesting. We have run out of time. There are a few questions, but I think it's already been 5:02, so we'll have to now wrap up the session here. So I request the Corpcom team to take over from here, please.
Well, thank you. Thank you again for all our guest speakers to take out their time for their insightful views. Thank you, dear participants, for taking out their time to attend this CareEdge webinar. Now, in case of any queries, feedback, or suggestion, please write to us at corp.com, corp with double M, at careedge.in. Goodbye for now. I request the tech team to log off.
Thank you, everybody.